Please join us tomorrow on Market Call. Andrew Moffs will be here. He's Senior VP and Portfolio Manager at Vision Capital. He'll be on our show taking your questions on real estate stocks. And if you missed an episode of Market Call, subscribe to our daily podcast, available on iHeartRadio, Spotify, and other of your favorite places to find podcasts. Time now for Brian Menden's top picks, the three stocks that he is putting in the spotlight today and favors. Number one, TFI International, the big Canadian trucking company, TFII in Toronto. Brian?
That's right, Paul. This is a fairly new addition to our dividend growers mandate late last month. It's a truckload, a less than truckload, and an asset-light logistics company. There's also a parcel and courier business rolled into one of those segments. Top flight management team led by CEO Alain Bedard. A lean operating philosophy that tries to maximize asset turnover by selling the right freight that matches their network and their assets and keeps the trucks moving. This is a largely undisciplined industry. This company is very, very disciplined, and that's the real magic here. So apart from being an efficient and scale-sized operator, it's also a company that's got a long history of consolidating the fragmented trucking industry. Late last year, early this year, they did a fairly large acquisition for a company called Daseke, and that's, I think, their 80th or so acquisition in the last 10 years. So some of them are small tuck-ins and others are larger. Fundamentally, we think the industry may be turning the corner. We've had 2 years of a manufacturing recession and a freight recession. But we see this company returning to double-digit earnings growth next quarter, and that earnings growth accelerating going into 2025 and 2026, with analysts forecasting 27% earnings growth next year and 24% on top of that in 2026. All the while, the shares are trading at 18 times earnings, so we see that as a very good combination of value and growth, given that historically it's compounded earnings at 20% growth over the last 5 years, and we see that accelerating in the coming years. So timely entry point here, we think. Okay. TFI is number one. Number two is Broadcom, ticker symbol AVGO on the NASDAQ Stock Exchange. Broadcom is probably the second best known to its much larger rival, NVIDIA, but it's a leading designer, developer, and global supplier of a whole range of semiconductor devices. Primary focus is on RF, or radio frequency, and optoelectronic applications. They sell into a number of end markets, namely cell phones, PCs, servers, enterprise storage equipment, telecom backhaul gear, and various industrial applications. But increasingly, they're making AI chips. And actually, there was news out in this company yesterday that they've been tapped to supply OpenAI, which is a real nod to their technical prowess in designing these chips. What we think is likely to attract a re-rating here is the big $70 billion acquisition they did late last year of VMware, which does workload balancing software for mainframes, distributed computing, and those sorts of applications. And that should attract a re-rating because it's high margin recurring revenue. The company, fairly rare among semiconductor stocks, pays a dividend and in fact has compounded that dividend at 35% over the last 5 years. Now, granted, that's probably not sustainable. The dividend growth is likely to moderate, but probably will stay at an elevated level because we can foresee earnings growth at a sustainable 20% pace over the coming 3 years. So good way to play the semiconductor secular bull market. And we own this in addition to NVIDIA in our other portfolio. So we've got both bases covered there.
Okay. And number three, a familiar name to Canadian investors, Alimentation Couche-Tard, ATD, on the Toronto Stock Exchange.
Yeah, this is the second biggest convenience store chain in the world. They have 14,500 stores in Canada, in the United States, in Europe, and in Hong Kong. Very profitable, earns about a 20% return on equity, grows nicely, even though the industry itself is a sluggish grower. They've compounded their earnings per share at a 13% pace over the last decade. And really the strategy is to use their procurement scale to price sharply on fuel. They draw traffic into the stores and upsell consumers in-store merchandise where the gross margin is 3 to 5 times higher than what they make selling a gallon or a liter of fuel. So very lean, efficient operator, and also, like TFI, a very experienced, long-tenured consolidator of the very fragmented convenience store industry. And notably, they've got their elephant hunting. They've got Big Target in their scope. And of course, that is 7&I Holdings, the parent company, Japanese parent company of the globally ubiquitous 7-Eleven chain. Ostensibly, this is a friendly pursuit. I'm not sure 7-Eleven sees it that way, but we're watching this one closely and think this would be great if they could get it done. It would be very synergistic if they can come to terms at a sensible price. So one to watch, and the pullback here makes for a very timely entry point into a great company.
Okay. Brian, thank you so much, as always, on behalf of our viewers for your time today.
Great to be here. Thank you, Paul.
Brian Madden was our guest on Market Call. Thanks in particular to everybody who put a question in. Here's a very quick look at markets. Here's a look at the main U.S. markets. We'll take a look at the TSX, and then we'll hand things over to Andrew Bell and Trading Day. There's a positive day south of the border. Here comes the S&P TSX Composite Index. It is trading down, and it's time now for Andrew Bell and Trading Day. Thanks for watching.